All right, so remember we're going to do objective 5.2 and 5.3 together. I think it might be a little bit longer video. I'm sorry for that, but I think it's really good that we put both of these in one video. All right, so we are going to go through learning how to account for a purchase of merchandise inventory under perpetual system, and we're going to do the sales of the merchandise inventory under perpetual. Okay, so the cycle of the merchandiser begins with the purchase of the inventory. There's going to be an invoice, and that's going to have a lot of details on it, like when it's due, who's paying for shipping. We'll get to talking about shipping here in just a little bit, but there's a lot of things on that invoice that affects our journal entries and how we account for inventory in the accounting system. Okay. All right. So here's a copy of an invoice. They give us lots of some detail here. This is a really nice exhibit. I like how they numbered it, told you what it is over here in the margin. That's really good. Okay. All right. So we are going to pick up the first entry we're going to do. They said Smart Touch Learning receives the goods from exhibit 5-3. That's right there. Okay. On June 3rd, and they make a payment on that date for that inventory. That's not always going to be the case. They're going to probably do some accounts payable and muddy up the water. So just be careful that you read the problem very close. Every little word, even prefix, can change the journal entry. Okay. All right. So they are going to debit the merchandise inventory. Remember, that's an asset, current asset specifically, and they're paying for it all at one time. Okay. That's also an asset. Did my total assets change after this entry? No, they did not. You traded one asset cash for another asset merchandise inventory. Now, remember, merchandise inventory is not as liquid as other assets. Okay, we kind of touched on liquidity and how turning something into cash fast makes it more liquid. If you think about how fast to turn all the merchandise inventory in a Walmart Supercenter into cash, that's going to take a while. Like it's not going to be a day or two. It would take a couple of weeks, maybe a couple of months to get all that inventory out of there and sold. And even if you did it that fast, you're probably selling it at a really deep discount. You're not actually, probably not collecting what you're carrying it on your books as. Okay. So realize if they had bought this on credit, this cash would have been accounts payable. Okay. But they said they paid for it on the same day. Oh, and look, they're going to make us do the entry on that as if it was accounts payable. So now we're going to assume the exact same entry and that it was done on account. Okay. So now this is an asset. Accounts payable, that's a liability. Okay. So you're not trading an asset for an asset. So if they ask you that trick question, did my total assets change? Yes, they did on this one because you didn't pay cash for it. Okay. You bought this asset with a liability. So your assets did change. Your assets actually went up by 35,000. Okay. So you just have to be really careful and read questions clearly. Write dates down on a piece of paper. They really try to get you with dates and trying to mess you up on these journal entries, but dates are very, very important. Okay. All right. Now we're going to come down here to purchases, returns, and allowances. Okay. This happens. You know, we just had the Amazon Prime Day here this summer. I always like save things up for the Amazon Prime Day and then I go and look, hey, is it cheaper? Is it a better deal now? So yeah, I'll buy it now because it's a little bit cheaper. Do we return a lot of stuff from Amazon? Yes, we do. Um, we return a lot of stuff. We take it to UPS. Once upon a time, we would take it to Kohl's and they would process that return for us so easy. They would give us a 30% coupon if you shopped in the store. So it was a genius idea for Kohl's to do that for a little while. I don't know why they switched to UPS. Maybe UPS had a better incentive for them than Kohl's. Okay. That was genius on Amazon, just getting anybody to do easy returns like has made probably made their business grow so much. Okay. But we do return things. Even a vendor may return things. I mean, a warehouser may have bought some chicken from Tyson and the chicken's bad. In that case, if it's bad, they're probably not going to send it back because why waste gas money on bad chicken? They're probably going to say, hey, if they've got a good relationship, they may say, hey, just put it in your dumpster. We're going to give you an allowance. Don't even send it back because it's worthless to us. We may even give you a little bit more if you'll put it in your dumpster. Okay. So that would just be an allowance where they take an amount off. The actual return is when they return defective, damaged, or, if they sent the wrong color, something like that. That would be the purchase return. Okay. I go back and I think about, when you have a baby, you get a registry like at Target or Walmart, and you can make these returns. And sometimes you return things to Walmart or Target and it's still good. I think I got like three changing pads that were exactly the same. The two that I returned were perfectly fine. They weren't damaged. So making the entry to put it back into the shelves is a very different entry than it's defective. We're not putting it back on our shelves because it's defective. We don't want to sell another defective product. So they may make the entry to credit the customer, but then they may not put it back on their shelves. Okay. I've often thought whoever's working that return desk probably does not need to be the newest employee that Walmart or Target has. It needs to be somebody who really understands that process and, let's just not, you know, do a return and if it's defective, keep on putting it back in our inventory because then our inventory is not going to be correct. Okay. So we do have those. We have sales returns and allowances. We're going to get to that in the next objective. Here we are talking about we are the merchandiser. We bought some stuff and now we're going to return it. Okay. So on June 6th, Smart Touch Learning returns 20 tablets from the June 1st purchase because they were damaged in shipment. These tablets were valued at a total of $7,000. Okay. So notice this entry is almost exactly the reverse of this entry where we purchased it. It's a little easy on the purchase sides of returns because we're just basically reversing that entry and taking them out of accounts payable. Okay. So I like to come out here and I know the accounts payable T account's already there for me, but we have 35,000 on the credit side. And now we're returning or getting a credit for 7,000 of that. Okay. So that means we don't owe 35,000 anymore. We only owe 28,000. Okay. So now let's look at purchase discounts. Okay. Purchase discounts are going to work very similar to sales discounts. They're read exactly the same way. Okay. So you're not having to learn two different types. Okay. So they have credit terms. And so down here they do 315 in 30. That means a 3% discount is given if they pay it within 15 days or the net is due in 30 days. Okay. Oops. Sorry about that. Okay. If when we get on the sales side, 315 in 30 is going to mean exactly the same thing. Okay. 3% discount. If it's paid within 15 days, net is due in 30. Because we're being offered an incentive to pay that bill soon because cash still pays the bills, even though cash wasn't involved here yet, but we still have to pay that 28,000. Okay. Another thing to realize is that they don't get a discount on the 35,000 because they returned 7,000 of it. It would only be a discount on 28,000. Okay, so don't get confused. We can't, and if they throw shipping in here, usually the shipping might be a third party, so shipping does not get a discount on that either. Okay, All right. So you might see one of these. I'm going to do another one just because you might see these. You might have 210 in 30. That means 2% discount if it's paid within 10 days. It may say NEOM, end of month. Okay. So those are just a few variations of credit terms that you might see. Okay. All right, so we're going to come down here under the credit terms of 315 in 30. Smart Touch Learning pays on June 15th, which is within the discount period. The company will receive a discount on the $28,000 balance. Okay, I'm just going to come over here. I probably should have already had my calculator up. I'm going to pull that up really quick. There it goes. It's in my recent. So we take the 28,000 and we're going to multiply that times 0.03 and we're going to get $840 discount. Okay. So 28,000 times 3% gives us 840. We will take the 28,000 and subtract 840 and that will give us, sorry, there we go. That gives us 27,160. I'm going to show you a quick trick on the calculator that might help you get to this just a little faster. You know, in math, there's more than one way to do things. So sometimes I'll take the 28,000 if I'm in a hurry, and I will just multiply that times 0.97, which is just 100% minus the 3%. And you still get the 27,160. You can do it both ways to make sure you have the right number. Okay. All right. So now we're going to come down here and they're going to pay the bill, I'm guessing. We just went a long way. There we go. Sorry about that. All right. So we still had that accounts payable that had 28,000 in it. I'm going to draw that out again just because. I'll just put the 28,000 because you know it was 35,000 minus the 7. Okay. So a lot of students want to come in here and they want to debit 27,160 to the accounts payable, but we cannot do that. There's $28,000 in that accounts payable. We have to debit 28,000 to that accounts payable to make it zero out. Okay. Cash is the 27,160. That's how much cash is leaving. Okay. The $840 gets credited to merchandise inventory. And I want you to think about the rationalization behind this. Okay. This accounts payable came because we bought merchandise inventory, right? Okay. We can't record that as revenue. We are going to take that and make the inventory value go down by $840 because we got the discount from paying for merchandise inventory. Okay, when we get to sales, there'll be a little work on that one as well. I'll kind of give you some tips on how to differentiate between the two. But again, this entry's got 3 lines on it. If you get the accounts payable right and you get the cash right, you might be able to reason out that third one or get it wrong. You get 2/3 of the problem right. And I give partial credit. So if you get half of the equation, half of the entry right, then you get half points. Sometimes those half points add up to a lot. But a lot of times it might help you reason out what the rest of the entry is. Okay. All right. So here is all of those numbers in the T accounts. So accounts payable has cash, I mean, has zero balance because we paid that in full. Merchandise inventory got credited for the 840, so the balance in that merchandise inventory is the same as the cash we paid, okay? And cash went down, so those are the accounts that were affected by that previous journal entry, okay? All right. Now we're going to assume instead that Smart Touch Learning pays on June 24th after the discount period ends. After the discount period ends, there is no discount. So it's rather straightforward. You owe 28,000, you're going to have to pay 28,000, okay? So you credit cash for 28,000, debit the accounts payable for 28,000. Realize in both of these entries, it did not matter if we had a discount or not, the same amount was debited to accounts payable. Okay, try to keep those things that are going to be the same every single time. Okay, so now we have FOB shipping point and FOB destination. Okay, I'm going to jump over here, and I like to use my husband's old job for this, and my worksheet is not cooperating with me here. All right. Sometimes OneNote just kind of messes up on you and you have to close it out. So sorry, I had to pause the video, and I got all these drawn out to demonstrate FOB destination and FOB shipping point. So my husband used to work at Performance Food Group in Little Rock. So I use them as an example just because it's kind of a real life example, but it kind of helps me. If I was walking in to take the CPA exam today, I probably would write this out on a piece of paper, not because I don't know it, but I haven't done a lot of these kind of entries, so I want to make sure I get them right. Okay. So let's look at, so performance, we're pretending we are PFG. Okay. This is us. Performance Food Group buys a lot of chicken from Tyson. They sell to places like KFC, Taco Bell, and things like that. Okay. So FOB shipping point, I'm going to come down here. FOB, these are legal terms, by the way. So if you end up taking me for legal environment of business, then we will talk about this exactly again, exact same way, because they're legal terms, because somebody has to own that product as it is going from one spot to the other. Okay. So if the terms are FOB shipping point, that means title passes right here at Tyson's dock. When it leaves Tyson, it belongs to Performance Food Group. Okay. This is really important when it comes down to end of the year. So let's say it left Tyson on 12/31, but it didn't get it would get probably between those two. But what if it was California to Arkansas? They may not get here till like after January. So it wouldn't physically be in PFG's custody, but it is theirs because the title and ownership passed at Tyson's dock on 12/31. It belongs to PFG at that point. Okay. When it's FOB shipping point, this means the buyer also pays the shipping. Okay. The buyer pays for the shipping. They own it while it's going here. They have risk of loss. So, and we've seen that before. We've seen 18 wheelers have wreck and all that inventory is destroyed. Sometimes it's funny, but um, depending on what's in the truck, but not funny if anybody gets hurt. But that happens. And so PFG has the risk of loss. Okay. So, if they're going to insure it, they're going to pay for insurance on it as it is going from Tyson to Performance Food Group. Okay. So that's FOB shipping point. Let's look at FOB destination, and FOB destination could be right there as well. Okay. I just don't have a lot of room. I'm going to come over here and write. I'll just come down here. All right, so we have FOB, and FOB means free on board or freight on board. In legal environment of business, we talk about free alongside. That has to do with shipping. So FAS, okay? So free on board, freight on board. Destination means title passes right here at the destination, okay? In this case, the seller pays the shipping. Okay. In this example, it looks like PFG is paying the shipping coming in and shipping going out. They are. These are all negotiated when they are purchasing, buying and purchasing stuff. Okay. So that's FOB shipping point and FOB destination. One other element to add to this, we are PFG, okay? Pretend that we are PFG because PFG is the buyer and the seller. It just depends on the transaction, okay? Any cost that they pay coming into PFG, that is an inventory cost. It gets added to inventory. Ultimately, it's going to end up in cost of goods sold, so it'll be above the gross profit line. This might make more sense here in just a little bit. Above the gross profit line. Any shipping going out is a selling expense. It goes straight to the income statement, and it is below the gross profit line. Okay, so it does matter if it's FOB shipping point or destination because that is going to trigger how you're going to record your journal entry and your shipping. Okay, so I just switched over there to do the FOB. I guess they kind of had a little diagram. I like mine a lot, so we'll just stick with that. Or if you like this one, however you learn it, I am okay with that. Okay. So freight in, freight out, I just said that is inventory cost. It'll get added as the cost of the inventory. This is that above the gross profit line. And then this one was the below. It's just easier to see in that diagram. So I went over there and drew that diagram out. All right, so here we go. Assume Smart Touch Learning pays a $60 freight charge on the June 3rd purchase with FOB shipping point. Okay, here we go. FOB shipping point, it was inventory coming in. We are adding it to merchandise inventory. So we're increasing the value of the merchandise inventory by the shipping, and then we're crediting cash because it said they paid for it. Okay, all right. Freight within the discount period. Okay, so let's look here. Under FOB shipping point, the seller sometimes prepays the transportation cost as a convenience and lists the cost in the invoice. So we're going to assume Smart Touch Learning purchases 5,000 of goods with a freight charge of 400, and on June 20th, on account with terms 35 in, I wonder if that should be 315. We'll see as we go through the calculations. Okay. So what is going to merchandise inventory? The 5,000 minus the 400 because we want to keep them separate, even though they're probably going to be in the same one. Sorry, I did not do that right. They have both of them. They have the 5,000 and 4. I thought that was a minus sign in between those. So they have both of them in there. Okay. And they're crediting the accounts payable for the total amount. Okay. It gets muddy when we try to do the discount because we can't get a discount on that $400. Okay. So the 5,000 times the 3% is 150. They owe 5,400. Subtract the 150, and that gives you the 5,250. Okay. But accounts payable is going to be decreased by the total amount, 5,400. Okay. And merchandise inventory is credited for the 150. Usually they do not include the freight. They actually included this freight and let them get a discount on it. No, they did not include that. I'm sorry. Because they based the discount 5,000 times 3%. So it did not, they didn't get a discount on the freight. They only got the discount on the merchandise inventory. Okay. All right. Knowing the net cost of the inventory allows a business to determine the actual cost of the merchandise purchased. So, net cost of inventory is calculated. We have the purchase. That's where we start with almost every single time. We'll start with the purchase. We're going to subtract any purchase returns and allowances, and we will subtract purchase discounts and add in the freight in, not the freight out, the freight in. Okay. So they give us a problem here. It said they bought that big number right there, 697,710 of inventory, returns of 150, and it takes a 95/10 early payment discount. So you can see that's a pretty big number for those are small percentages, but they can add up to a huge amount. Okay. So then they paid 36,400 for the freight in. Okay. So some of your problems are going to give you a list of these. They're going to give you more, and you've got to pick out what you need to calculate the net purchase. So they started with the net purchase, subtract the returns and allowances, subtract the discounts, and add the freight in to give that inventory $574,600. The salespeople, need to know this because they need to make sure that they don't go sell that inventory for less than that. Okay? Because if they sell it for less than that, they are losing money. Okay? All right. So we are on objective 5.3. We are going to look at the sale. I know this video is a little bit long, but I think it would be really good for us to see both sides, the purchases and the sales, to go along together. Okay, so now we're looking at sales in a perpetual system. Okay, this is where it gets a little bit complicated when we sell things in a perpetual inventory system. So remember I said when you go to Walmart self-checkout and you scan an item, you're ringing up the sale. You're also taking it out of inventory. On the accounting world, that is two journal entries. So anytime you have a sale under perpetual inventory, you always have two journal entries to make every single time. Okay. So let's come down here. The first thing they're going to talk about is cash and credit card sales. Okay. Credit card sales account for a lot of sales that happen at Walmart and Target. Realize that when you go and you use your Discover card or MasterCard at Walmart, not talking about debit cards, but your credit card, Walmart has to pay a fee for that. So if you spend $100 using your Discover, Walmart's not going to get $100. They're going to get $100 minus like 3%. Okay. They're willing to accept that fee because they get that cash really fast. Okay. Visa, MasterCard, the turnaround on that is just a few days. When I was a bookkeeper at the hotel that I worked at while I was going to college, it was about 3 to 4 days. Sometimes we would hold bills that we needed to pay on Friday. We would hold them till Monday because the credit card entries would get funded over that weekend, and then we can mail those bills out on Monday. Okay. So there's always two entries. So here we go. Smart Touch Learning sold the two tablets for $1,000 cash. The tablets had a sales price of $500 each, and each tablet cost $350. Okay. So it said that it was cash. So first entry, we got cash. I don't know if you can see it. I'm trying to not let you see the entire entry and muddy up the water. We're debiting cash. You go to Walmart, you bought two tablets, you gave them $1,000 cash. We're debiting cash. We are increasing cash. Okay. We are going to credit sales revenue for that exact same amount. Okay. But then we've got to take it out of the inventory. And I always tell students, get the sales entry first. That's usually going to be the larger number. Get the sales entry first. I don't really know if my accounting lab cares which one you're doing first, but it'll help you if you get in the routine of always putting the larger number first. Okay, the sale. Okay. They said that it had cost of $350 each, which would give us a total of $700. So we've got to take that $700 out of our inventory and send it to cost of goods sold. So we will debit cost of goods sold. That's our expense. And then we will credit merchandise inventory for those two tablets that cost us $700. Okay. That's how much it cost Smart Touch Learning to purchase those tablets. Okay. So that's an expense. Your merchandise inventory is an asset. That asset's going down because you're selling that item. Your sales revenue, it's a revenue account. So now you can kind of see that sales revenue minus the cost of goods sold for this particular one ended up with a gross profit of $300. Okay. All right. They've got the T accounts down here at the bottom. So they're taking that out of the merchandise inventory and sending it to cost of goods sold as an expense. Okay. All right. I kind of already talked about credit card sales. We're going to look at this. I don't know if they give us an example or not. Um, it looks like they're not. They're just telling us about it, and I've already talked about it, so we'll jump on to the next slide. Okay. Sales on account with no discount. This is good to start off with no discount. Remember the discounts we talked about for purchases? They're going to work exactly the same. Okay. So here is the invoice for the two tablets sold on cash. Okay. There was no discount. All right. Now we're going to say Smart Touch Learning sold 5 tablets for $500 each. My sales revenue is what, 2,500? And each, I'm sorry, making a $2,500 sale on account for June 21st. The goods cost $1,750. Anytime they're giving you that number, you should in your mind red flag there's going to be two entries. Okay, so we're going to record the sales entry first. We are going to not debit cash because we didn't get cash. The previous one we got cash. We are getting accounts receivable now. So accounts receivable is the asset. Remember, accounts receivable is a promise for them to pay cash sometime in the future. Okay. I know a lot of people just want to accept cash, but that's if you only accepted cash and you never extended credit to anybody, your sales would go down a lot. Yes, there is a risk of non-collection, but you want your sales to go high too. Okay. And you'll find that business to businesses trust is a little better. So me and you can't walk into Walmart and say, "Hey, I want to get $100 worth of groceries. I'll be back at the end of the month when I get paid and pay the $100." They're going to arrest us, right? So business to customer, not so much trust. Walmart would be like, "You can fill out our credit card application. You can get a credit card to buy your $100 worth of groceries, but we're not extending credit." Okay. So just keep that in mind. Business to business credit happens a lot more frequently than business to customers. Okay. And they told us those goods had a cost of $17.50. This journal entry here is almost identical to the previous one, except for we got cash in the previous one, and this one we got a promise to pay cash for them to pay us cash in the future. Okay. Let's do this with a discount. Okay. So we've kind of already talked about it. We're going to look at June 23rd. They sold 15 tablets for $500 each with terms of 2, 10, and 30. And the goods had a cost of $52.50. Okay. So 15,000, sorry about that. 15 tablets times 500 gives us 7,500 in sales. Okay. 210 in 30, 2% discount if it's paid in 10 days or the net is due in 30. Okay. So the first entry, we're going to debit accounts receivable for 7,500, credit sales revenue, and then we're going to debit cost of goods sold and credit merchandise inventory for the goods. Remember, 7,500 was the sale and the cost of goods sold was the 52.50. The sale is usually the higher number. Okay. All right. So they're going to get a discount now because they're going to pay it within that discount period. They purchased those on June 23rd. So it looks like they need to collect that. It said when the customer makes payment within the discount period, they'll record the receipt of cash and decrease the accounts receivable for 73.50. So you can see if I drew my accounts receivable T account out, we had 7,500 in there. That was from the previous entry right there. And we're getting a $150 discount on that. Okay. But we still have to credit accounts receivable for 7,500. If we went in there and credited it for 73.50, we'd have that 150 left in this accounts receivable, and we don't want to do that. We want to make sure that goes to zero. Okay. We are going to get cash of 73.50, and now the discount will go to an account called sales discounts. Okay. The other one, on the previous one where we did a discount, it was merchandise inventory. So what I always try to tell students, figure out your receivable or your payable, then figure out your cash. If you need a debit, it's always sales discounts. If you need a credit, it will always be merchandise inventory. I don't say a lot of always, always, always rules, but that is an always rule. Okay. So you got to figure out receivable or the payable. Cash, if you need a debit, goes to sales discount. If you need a credit, it will be merchandise inventory. Okay. All right. So if the customer does not pay within that discount period, then it makes the accounting super easy because they didn't get the discount. So 7,500 will get 7,500 cash, and we will credit their receivable for 7,500 because they have paid us now. Okay. Sales returns and allowance. The return of goods by the customer is called a sales return. Very similar to the purchase returns and allowances, except we're just on the other side. People are returning, customers are returning stuff to us. In the previous example, we were returning things to the vendor. Okay. This is where, the sales return, I may bring something to return to Walmart. If it's perfectly fine, they can put it back on the shelf. Then they're going to do a return. They're going to credit me my money. They're going to put it right back into inventory. If it's damaged, they're just going to do the sales allowance and they'll give me my money back, but they won't put it back into inventory. Okay. So I think we have an example here. We have on June 30th, Smart Touch Learning grants a $100 sales allowance for goods damaged in transit. Sometimes that happens. Something got damaged on the way, and instead of taking it back, we're just going to give you some money off of it. Okay. Depends on what the damage is, if it's still good. Okay. So the goods were sold on account, remain unpaid. So we are going to debit sales returns and allowances and credit that receivable for them. Okay. All right. We are almost done with this objective. Then when the customer, Pendleton Dentistry, pays the amount owed on June 30th, Smart Touch Learning records the receipt of cash and decrease in receivable for 2,400 because remember we gave them that $100 sales allowance and they only owed us 2,400 at the time. Okay. That's a lot. All right, transportation cost. I know this is a long video and I am sorry. Transportation costs, freight out, okay? Freight going out, remember, I drew this diagram out over here. This is freight going out. It is below the gross profit line, so it gets put into a journal entry, and we are going to debit an expense for $30, credit cash for $30. Okay? I will see y'all in the next objective 5.4.